Welcome back everyone to the second rendition of our tax talks with our very own James, where we continue discussing topics of international tax. So James, in June this year, KRA hosted the 11th Summit of the Africa Initiative, which I understand is a program established to ensure that African countries are equipped with the skills to exploit the latest in tax transparency, right? So what's your take on such initiatives, and is Africa benefiting from the global tax transparency initiatives that are being carried out?
Thank you, Abdullahi. And as I mentioned in the first part, that I was privileged to, at the early stage of the Global Forum work, to identify this as a huge gap, that Africa was not being involved in the conversation on tax transparency. So whereas the rest of the world was moving forward, was very actively engaging on the different standards, the presence of African countries and key decision makers in the Global Forum on Transparency space and what were the benefits was not really percolating down to the policy makers. So I, at the time, with the head of the Global Forum on Transparency, Monica Bhatia, we made the case that was then put forward in Berlin that we need to have an African initiative. Why is this important? This was going to be an initiative to come back now to bring the discussion down to the African context. What that means is that very high-level policy discussions within Africa could take place. So it's been a very important policy dialogue forum where governments can discuss about or be made aware of what's going on a global scale, to know what it is that the African countries should do, and also from a donor-driven capacity building, the issue that funds could then be mobilized through this initiative to ensure that countries were given the resources, the technical assistance to comply with the standards, to know what it is they need to put into place. So as we speak, African countries, I must say there's that real risk they get left behind of all those benefits. And I would say would make Africa, to be honest, what I would call a tax haven of its own. Why? Because there's if you look at the transparency standards, if we're not playing with the rest of the world, it means this is where businesses would come and keep money or do business, and there's no way to know actually what they're doing. So the standards on beneficial ownership, for instance, the exchange of information between tax jurisdictions. African countries have very limited tax treaties with themselves, with each other, with other African nations. Within East Africa, for instance, we actually do not have a double tax treaty with its exchange of information. And these are our biggest trading partners. So the lack of instruments for exchange of information is a huge gap. And as I said, the issues of capacity, a huge challenge. And then as the standards have also developed from the exchange of information on request to the automatic exchange, to these issues also on beneficial ownership, all very critical issues for ensuring governments now have access to that information. Now become very vital, that such initiatives need to continue running, need to continue being funded, and to ensure that African governments take or get on board on those things they need to do to ensure that they are better able to control taxpayers or economic activity, to have better information that helps them to collect tax.
Oh, amazing! I mean, with all things, information is king, right? In all things, and more so from a tax perspective. And so then now brings me now to my next question: is could you please give our viewers and our listeners really a brief overview of the common reporting standards and the country-by-country reporting rules, and how this feeds into the tax transparency agenda?
Okay, so I've mentioned earlier that there are a number of standards on exchange of information. First, beginning with exchange of information on request, to develop standard on beneficial ownership, meaning that governments should better know who are the ultimate owners of any particular company, to now the common reporting standard, which was, say, now countries would be able to exchange financial account information about citizens of a given country. So say, for instance, you have an account as a Kenyan in Switzerland, that once there's in place that exchange mechanism between Kenya and Switzerland, is that Switzerland would be obliged to share information of all Kenyans who keep an account in Switzerland, and that information is relayed on a spontaneous basis to the Kenyan government, and the tax administration should be looking at this to say, well, now we were not aware that Abdullahi has an account in Switzerland and is keeping money. Then there's a question, is this money money that has arisen from business? Can we then bring this income to charge? So this whole question, it's very important that common reporting standard is about countries being able to exchange information about accounts, financial accounts, banking from a given country. And so that also requires that each government put in place that mechanism internally, that its own banks collect that information to be able to then transmit it to other jurisdictions. I think the US FATCA, Foreign Account Tax Compliance Act, was actually the forerunner to the CRS, because that then said the US government could collect information about all US citizens. So the rest of the world said we want a similar tool. And so FATCA and CRS are like two sides of the same coin. And, and the common on the country-by-country reporting was an outcome of the base erosion profit shifting project, which is to say that improved documentation for risk assessment purposes. The tax administration would be entitled to look at information about where a multinational has reported its profits, how much economic activity in each of those jurisdictions, how many people, what sort of resources does it have in each of these countries, to be able to assess. If you have very limited resources, employees say in one country, but when you look at the profit reported in that country, it looks significant, then there's a question that the tax administration would now want to look deeper into these issues. Now, from an African perspective, one of the big challenges, for instance, is how much work needs to go into actually being able to exploit those tools. Currently, there are only 2 countries in Africa that are receiving country-by-country data. Why? Because you would have to do a number of things to be able to benefit. One, you need to have put in place the exchange tools on the multilateral convention. You need to have signed a competent authority agreement. You need, there's sort of stages on confidentiality. They have to come and assess your ability to implement or safeguard information, to join you onto the pipeline to be able to receive this information automatically. So there are costs involved, there are technicalities involved, there's all that legislation to put in place. So clearly, still quite a challenge for most African countries to implement.
Oh wow, perfect. And then now narrowing it down back to Kenya, so what strides has Kenya made to incorporate CRS and country-by-country reporting in its domestic legislation?
Yeah, so it's interesting to see, Kenya has been a member of the Global Forum on Transparency for several years now. I mean, starting from perhaps 2010. And also as a member of the steering group of the Global Forum, that Kenya should have moved quite some steps. And what we've seen now is that Kenya signed the Multilateral Convention on Mutual Administrative Assistance, which is a tool that helps Kenya be able to exchange information with over 120 countries, I believe, and tax jurisdictions, and put in place the legal regime, for instance, on country by country. These were amendments made in the Finance Act, the recent Finance Act that was published. and the regulations on common reporting standards were published for public participation, yet to be gazetted. But we know on the back end there is also work to be done to ensure that Kenya now is in a position to exchange this information bilaterally with other countries. So there's certain tools, like I talked about, the competent authority agreement on exchange of this information for both those, the CBC and the common reporting standard. And so there's still quite some work to be done for Kenya to be able to start to run this. But I note that, like, the law has already kicked in for CBC reporting. I think effective January 2023, countries would be, companies that meet the threshold would now be required to start to report whether they are the ultimate parent entity and to then comply with the law.
Right, perfect. So if I may, I'd like to now switch to a different gear now.
Sure.
And address the issue of tax competition, right? And tax competition has been addressed as you know, been a key reason why you know, the issue of tax havens have cropped up. Now, with the so-called tax competition and the race to the bottom, a proposal has been, you know, the introduction of a global minimum tax, which is a floor, to make sure that, you know, we avert tax competition. So now my question to you is really, from your perspective, can you say that the global minimum tax can actually avert tax competition and reduce the so-called race to the bottom?
Yeah, thanks for that question. I think it remains to be seen first how effectively this will be implemented. The global minimum tax proposal to say 15% by all jurisdictions, it's interesting to see how countries begin to vary how this will be implemented. And I think the biggest challenge, can you eliminate tax competition? I think just like anything else, self-interest seems to get a lot of public policy decisions. Electorates are pushing hard. When I give the example of the small island states, who are majority of what you call the tax haven or low tax jurisdictions, these very small islands have no other economic way of earning revenue for their country. So this is the one tool they use perhaps to attract finance, to attract you know, sort of revenue for the government. So huge challenge now. Do they give up this income, and what do they get in return? The small island states, for instance, are the biggest hit by climate change and rising sea levels. So they're being tasked to let go of an income and suffering other adverse impacts. How do they just say now all of a sudden we are going to sort of maintain this minimum tax? So there's a whole question that competition is real and it's going to continue. It's very difficult to see how there's policing of that minimum tax to the extent that no government that is sovereign in its own taxing right will then determine that we will be even with everybody else. So I certainly see challenges in the implementation of that. I certainly see variance of, with every policy is always sort of a countermeasure to sort of ensure that some people stay ahead in the game. There's also that challenge that a few governments may be talking one thing and not able to also implement. So it remains to be seen what the effect of that Pillar 2 proposal will be on tax competition.
Yes, so allow me to now change the conversation and segue into the ESG question. I mean, the COP27 has just concluded in Egypt, and the ESG question and concern is such a strategic objective for governments, businesses, and policymakers alike. So in your view, what is the role that multinational enterprises can play right, to be in being more proactive to address, potential tax risks and operate more responsibly in a way that is consistent with their ESG obligations?
Right, I think it's a very interesting question. And just to say, complying with tax rules is core to business responsibility. Businesses have a fundamental responsibility to comply with tax legislation in every country they operate in, to pay at the right time, to pay the right amount of tax. So it's interesting now that the discussion is in place now to say that as far as the SDGs are concerned, that businesses also have a role to play. And central to this conversation is the UN Global Compact, where businesses now are being required to sign, and to state that they affirm the principles around business, responsible business conduct. And central to this conversation is also now, particularly on tax. And there are several elements to this. One is on greater accountability and transparency in the way you do your tax governance. Are these issues being dealt with at a strategic level? On issues on the way you do your tax planning, for instance, should you exploit, things in tax havens purely for tax purposes, or is it that you have a legitimate right to perhaps take advantage of tax incentives, but ensuring that you still remain responsible enough within the countries where you're earning the revenue to give back? I think the US have an expression they put somewhere there on one of the key government buildings to say taxes are what we pay for civilization, for civilized society. So it's imperative then that companies also see a role they have in self-regulation, in adhering to standards of the way they engage with the tax administration, ensuring that they are able to cooperatively comply, meaning where requests come, they're open with the tax administration, they're willing to give information, they're willing to comply with requests, and they're openly engaging. So I think there are a lot of certainly very good principles, even from the OECD BIAC, which is the Business Investment Advisory Committee of the OECD, and another very great example, the B team principles. Our very own Bob Collymore, the late Bob Collymore, was part of an initiative they called the B team principles for international business, or responsible tax principles, which are a very good place for any business that is looking to incorporate tax responsibility into its ESG framework. And we certainly, as Anjarwalla Khanna, is something we're able to assist any company that is sort of looking in this area, would like to put up this as part of their framework, would happily assist.
Oh, amazing. So as we come to our conclusion, it's been such an amazing opportunity to, get to have this conversation with you. Could you give our viewers and listeners a parting shot on the back of what we've discussed today?
Yeah, thank you so much. I think these are really interesting times for Africa, very interesting times for business, an opportunity perhaps to reset and relook at the way most business have been doing. Companies have been doing business in Africa, to relook at their own tax structures and ensure they certainly do align to the emerging principles, the emerging trends in sort of compliance, and also perhaps that open atmosphere of engagement with tax administrations, as opposed to being confrontational, to be a bit more focused on cooperation and how that can be improved. So we certainly see interesting times for me also, who's been more on the policy and tax administration side. I think there isn't a more interesting time that now businesses, it's time now to ensure with all those changes, it's time to also ensure that businesses, can operate in a better, in a more certain tax environment, because clearly a lot of disputes will arise with the emergence of all these rules and legislation and things that need to be changed, the way tax administrations are looking at these issues. So clearly a lot of support is needed, and some investment clearly would need to be made by businesses to certainly ensure that they don't run foul of any of this new legislation. So interesting times. I think I look forward to being of assistance and to have more and more opportunities to engage in this very interesting debate. Thank you.
James, thank you so much for your time today. And thank you to our viewers and our listeners. This conversation is available on the ALN Academy podcast and our YouTube channel. Please leave a like, subscribe, and please make sure to hit the notification bell so that you can be notified when we when we have new updates. Thank you so much for having us, and we hope it was a pleasure. Thank you.
Thank you.